Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the fourth quarter, bonds made a smidgen while stocks rallied and did well. Inflation calmed down some to 6.5% from 8%. Wage inflation is still high but has eased slightly. The Federal Reserve again cranked up short-term interest rates at an unprecedented clip, but slowed a tad on its last hike in December. For the year-to-date, U.S. large companies rebounded on the favorable inflation trend, ending the year at negative 18%. Yes, that's better news than we had before. U.S. small company stocks felt some optimism as well, finishing down 20%. Overseas stocks had the biggest turnaround, back up to a negative 16%. Bonds, the biggest no-show in this bear market, remained down at negative 13%. That's a big loss for them. Pros say we can expect better from bonds in 23. Earnings from large U.S. companies are expected to drop 2% this quarter from last year's fourth quarter. They're predicted to grow 5.6% overall this year from 2021. More importantly, what's ahead for 2023? One viewpoint has earnings growing by 4.4%, not too bad. A second approach, though, is calling for a negative 2.7% drop. Both pale in comparison to what firms enjoyed in recent years. The stock market trades at a multiple of these earnings. It's fairly valued now in the middle of that historical range. The market is not cheap, but neither are valuations high as we knew they were back in 2021. Most businesses managed the quarter well, using higher prices to offset lower unit volumes in some cases. That means they sold less, but the prices were high, so their total revenues were about the same. Higher capital costs from those Fed rate hikes will start gripping growth. You've already seen housing slow as mortgage rates jumped. Labor is easing only slightly, but employers are not paying up as much for workers. Jobs are still being created at a healthy pace. The unemployment rate remains a tight 3.5%, even though the labor pool has grown as some folks return. Inflation on both wages, 5%, and what we buy, up 6.5%, remains high. GDP growth is huddling around the 0% line this year. Third quarter grew 3.2%, offsetting the first half's slight decline. Real GDP is expected to be up 1.9% for all of 2022. Some pros predict 2023's GDP growth will flatline at 0%. Central banks in most of Europe and Asia are hiking interest rates as well to combat high inflation. Some of those central banks have paused their rate hikes now. Most economies overseas are in a slowdown with recessions predicted. Their inflation rates appear to have peaked as well, just like ours. China is reopening with a vengeance. Their travel and consumption is jumping even as they deal with high COVID contagion. Russia's war on Ukraine continues, but its shock effect on energy and food prices has been mostly removed. Bear markets are easier to endure when they're sharp and short, rather than a long, drawn-out slog. It's possible stock prices may remain low if earnings drop further, as many predict. It's possible stock prices may drop more if the Fed hikes interest rates over the 5% point, which most pros expect right now. We're at 4.5% now. What did the fourth quarter have to be happy about? Why did stocks rally? Those investors see green shoots that inflation is easing, which in turn may convince the Fed to stop at 5% and hold. But until those signs of inflation clearly ease and ease enough to influence the Fed to pause on rate hikes, the market remains subject to uncertainty, and we've got a rough ride ahead. A soft landing of growing earnings with some rate hikes is still possible. There are plenty of experts in each camp, some predicting a soft landing, some predicting a recession. Bear markets average 14 months, but can be as short as 2 months or as long as 2.5 years. When does this bear market end? When there's more certainty on inflation levels and on the Fed's interest rate moves. Remember, there's a difference between the economy and bear markets. The stock market prices for green shoots, while the economy lives it. We've kept our portfolios diversified over different asset classes. This year, bonds should start mitigating the losses in stocks instead of adding to them. As long-term investors, we know corporate earnings will move back up after this slowdown. I am most thankful for your experience with these cycles and your patience. Thank you for your interest. Please call or email if you want to dig in further. I am glad to pass on my readings, podcasts, and the other sources I use.